Students, you guys asked for a video lecture on perfect competition. I want to give you everything you need to know for perfect competition. So this is just about everything except for the shutdown rule. The shutdown rule is already been made and it's in a separate video lecture. All right, so what are we going to learn today? What do we need to know? We're going to look at the assumptions of the model. We'll look at the profit in the short run versus the long run. And finally, we'll look at the strengths and weaknesses of the structure. So please note, write down all these assumptions. I would encourage you to make the diagrams as you see them. When you make the diagrams, your muscle memory starts to trigger, and you're able to make them over and over. So I would encourage you draw these diagrams again. And finally, take particular note of these strengths and weaknesses, and we'll get right into it. Okay, so perfect competition, the assumptions of the model. What do we come to expect from the perfectly competitive market structure and the firms in that structure? One, low barriers to entry. It is easy for firms to get in and out of this market structure. Next, the firms within this market structure are price takers. They have no price setting power. Whatever the market dictates, whatever the market price is, those firms have to, deal with that price. Because we have really low barriers to entry, there are a large number of firms. There are a lot of competitors in this market structure. Generally, we have homogeneous products. Meaning that they're identical, they're all the same. And we'll give you a couple examples of products in just a second. We don't have any non-price competition generally in this market structure. You won't see different producers advertising their homogeneous products. And the reason for that is if you have perfectly identical products, there's no reason to buy someone else's over yours if they're identical. It'd be difficult to try to create some sort of difference in the consumer's mind. We also say that with perfect competition, there's perfect knowledge about the market for both producers and consumers. They know what's produced, how it's produced, they know the price. So we have basically perfect knowledge, or we have symmetric information, would be another way to think of it, about the goods and services produced. Generally, when we think of these markets, we think of commodities, raw materials and foodstuffs, whether that's wheat, rice, certain types of fruit, could be metals and timber. And the best example is foreign exchange. That is by far the best example for a perfectly competitive market structure. But just to kind of revisit one idea real quick, if you look at, for example, a market, if you're looking at the market for, I don't know, just normal wheat corn, the thing the bloom that the wheat produces, the raw material. Depending on the area of the world you're in and what's grown there, if there's one dominant type of wheat grown in the United States, for example, all of those little corns of wheat, all that raw material that's produced in all those fields could, in theory, be totally homogeneous. Or, types of wood that you harvest from different areas of the world, the wood, is maybe got a very similar or identical makeup in terms of its density and all these other things that have to do with it. So just note that these are homogeneous products. They're generally all the same. Okay, now let's get into the perfectly competitive firm in the long run. Over here we have the perfectly competitive, or we just have a market, rather, and over here we have a perfectly competitive firm. And we can see that the price of whatever good we're talking about is $10 or 10 euros, whatever currency we're talking about. So let's just say it's $10. And we can see that the quantity, which is undefined, is in millions of kilograms. So we just know that overall this market is a very, very large market. This producer he is pretty small in comparison to the market. I mean, there's millions, who knows what this undefined number could be, 10 million kilograms. The individual producer has a relatively small level of output in comparison to what the whole market's producing. So based on that, we can kind of understand why there's no price setting power. This little producer that only makes 20 units doesn't really have the ability to impact the market based on how little they produce within that market. So they have to take the price that they've been given. Okay, so it looks like the market equilibrium price is 10, and we can see that same price kind of will make its way over to the individual firms' cost and revenue curves. So here's the price, and the price will be identical to the marginal revenue, the demand for that producer's goods and services, and the average revenue. You're probably noticing that the demand is for that individual producer's goods is perfectly elastic. That is because if the individual producer makes his 20 units, if he, based on the current market, he's such a small participant, he should be able to sell his 20 units in the giant sea of whatever this is at the prevailing price, and that's why, whether he makes 10 units or he makes 20 units, generally all those units will be able to be absorbed by this larger market. Okay, so let's talk a little bit about this perfectly competitive firm in the long run and look at the profit and loss that they're earning. If we want to figure out the revenue, what we're going to do is we're going to do price times quantity for that individual participant in the market. Let's see, the price is 10, the quantity is 20. So we can figure out real quickly that that individual producer is making $200. To figure out the costs, the total costs, we can look at this average cost curve. And it shows different the average costs at different levels of output. So, maybe this is 10 units. We can see that at 10 units, our average costs are higher. For 20 units, our average costs are lower. And if you were to look over here at the cost and revenue and sort of connect it with the amount of units produced, you can see that the cost, or the in this case, the price of the cost, is right here, and it's identical to the average revenue and the price, and so it's at 20 units, it's also a cost of 10. So if I wanted to figure that out, I could take the cost of what it cost me to make 1 unit, so the average cost, and times it by the number of units I made, and I could figure out the total cost. So in this case, it's the same. It's 200. So when our total revenue equals our total cost, from an economics perspective, we call this normal profit. And this is basically a situation where the firm is not making, money hand over fist. They're not making abnormal profit, but they're making enough that it is not incentivized for them to switch to another good or service based on the opportunity cost. So we're going to stick with whatever we're producing if we're earning normal profit. Okay, so let's look at what happens, though. What happens to firms in the short run? So this is the long run. We're always going to go back to this, but let's look at the short run. So we've got the same diagram again. We can see we've got the same profit, but something happens. Maybe demand for whatever raw material or commodity rises. Maybe that's because there are more consumers in the world, or maybe that's due to the taste and preferences of those consumers. But for whatever reason, demand rises in that market. And the new equilibrium price we can see is now 12. Well, because the individual producer is a price taker, we're going to have our P-Murder curve shift upwards to that new equilibrium price. And you can see right here that our revenue, our average revenue, should be in line with the price that the market dictates. And apologies, I couldn't get this to move up. There's just so many animations on this page that I couldn't find a way to make it go up. But just note the price should be up here, and our P murder curve has gone upwards. So now our revenue, the amount of money that we earn on average for every unit, is higher than it used to be, whereas our average costs have stayed the same. So it's important to note that firms always produce where marginal cost equals marginal revenue. And previously that point was here. But now that marginal cost and marginal revenue intersect at a new point, we're not going to produce there anymore. We're going to produce here. And we used to produce 20 units, but now we're producing 25. What's happening in the market kind of makes sense for what's happening for the individual producer. I mean, demand has risen. People want more at every price level, and now the individual producer is also making more. So looking at that, we can see also that we have a different average cost at that level of output. When we produce 25, because that's where MC equals MR, our costs, our average costs, are lower at that amount than our average revenue. So what do we want to do there? Well, we're going to basically draw a little line from that point where it intersects over to our y-axis. And that is going to be our abnormal profit. And that is because, if you think about it, it used to be that it was $10 in revenue for every unit we made, and it cost us $10 to make every unit we produced. So we were making normal profit. In a business sense, we were breaking even, I guess. But now that revenue has risen because we're getting more money for every unit we sell, it's now higher than the cost at that level. So when a revenue is higher than cost, generally we're making abnormal profit. Let's go ahead and figure out our new level of profit or loss based on that. So we can see that the new price is 12. 12 times 25 would be 300. So 300 is our revenue. And we're going to do the same thing with the costs and times that by the amount produced. So we'll take the average total cost times the quantity, which is 10.5 times 25. And we can see that our costs are 262.5. So now we're earning an abnormal profit of 37.5. And so the firm is making money. So in the short run, things like this do happen. We do have rises in demand or an increase in demand that might cause prices to go up and revenue to go up for producers. The thing is, this abnormal profit in the short run is enticing to a lot of other suppliers. People that aren't making this particular commodity or material or whatever perfectly competitive good this is will see that abnormal profit that some people are making, and they will also want to make that abnormal profit. And this is just sort of the way of the world. This is the way that economics works. People want a piece of that action. And so they start to produce that same thing themselves. When more people enter the market or more producers enter the market, we'll see an increase in supply, which will cause our prices to drop. As you can see, we went up from D to D1, and then now we drop from S to S1, so the prices are we have a new equilibrium price that's lower. So we're going to use a new slide to show you what happens now. Now that all these new firms have entered the market, we've got a lower equilibrium price. Looks like the price has dropped from went all the way up to 12. Now it's down to 5. We've got a new MC versus MR point. We can see that it's now 10. Marginal cost equals marginal revenue right there. And so based on that, we could figure out our revenue and our costs. Let's go ahead and figure that out. So again, the price, the P murder curve is now lower than what it used to be, price of 5, and we're making 10 units. If we were to draw that go from that number 10 all the way up to the average cost curve, we could figure out what our costs per unit are. And we're going to just kind of say that they're 11. This one goes up to 11. Okay, that's a Spinal Tap joke, apologies. Okay, so what we can see now, though, is that our average costs are higher than our average revenue. So when our costs are higher than our revenues, we're losing money. So we have a loss. Let's go ahead and figure out how much we're losing. Maybe you can do the math this time on your own and then check and see if you got it right. Go ahead and pause the video and see if you can calculate the loss. Did you figure it out? Okay, let's check and see if you got it right. Well, we'll take the total revenue times the quantity to figure out the price times the quantity to figure out the total revenue. So we've got 5 times 10. Now we're earning $50. However, when we look at that average cost times the amount we produce, we've got 11 times 10. Oops, typo on my part. That should not say 11 times 10 would be how much? Not 120. 11 times 10 would be 110. That's my fault. Please disregard that. I'll try to edit it out if possible, but I'm not willing to stop the PowerPoint at this point. So it gives us a loss of 60. Again, apologies, it's 10 times 11 is 110, not 120. So it's a loss of 60. Just ignore the 120. All right, so moving on. What's going to happen as a result of that loss? Well, some producers within that market structure, because of the low prices, will now leave. They will exit the market. When that happens, we will have supply shift back because now we have a fewer number of producers, and number of producers is what is a determinant of supply. So supply will shift back to the left. When that happens, the P-Murder curve will also change, and we will go back to the long run level of output. Now I apologize, I couldn't get this to line up perfectly, but that is because the PowerPoint is kind of finicky. It wouldn't let me put it right on the line. It's very particular about like where you put stuff. I couldn't get it to perfect line up, but in theory there should be no distance between this. All of this should intersect at one point right here, and we're going to go back to earning normal profit. So just note that we're going to go back to that same thing that we saw in the very beginning, where we had 200 in revenue and 200 in costs, and we were earning normal profit. So please note that in the short run, prices can rise, prices can fall, but in the long run, we always go back to this diagram for perfect competition. And this is really important. It's one of the key sort of concepts with perfect competition. All right, so let's kind of go on to our next concept, which has to do with allocative efficiency and productive efficiency, which is one of the strengths of perfect competition. Allocative efficiency is basically when it's an allocation of resources that is optimal from a societal standpoint. So when we look at the best uses of resources in terms of what society wants, this perfectly competitive market structure is actually desirable, and that is because when we look over here at the whole market, being at the equilibrium price, we're going to have the same amount of consumer surplus and producer surplus. We will have what's called a Pareto optimality, which is basically where both consumer and producer surplus are maximized, and you can't make one group better off by making another group worse off. So we're at equilibrium, and equilibrium is a good place to be. We're using our resources well. We don't have a shortage, we don't have a surplus. This is a good thing. When we look at this from a perfectly competitive firm's perspective, we're going to say that this point is where P equals MC, where price equals marginal cost. So the price, or the P-murder curve, is intersecting with the marginal cost curve right there. They intersect, and it's the same as the market equilibrium. So we are allocatively efficient. So please note that if you're ever asked this on an exam, that point right there is allocative efficiency, and it's where price equals marginal cost. Some other economists also say it's where price or average revenue equals marginal cost, but either or is fine. The other really great thing about perfect competition is it is productively efficient. We are producing, and that is defined to produce at ATC's minimum point, or producing at our lowest, the average cost of production, or the cost per unit is at its lowest point. If you think about it, when costs are low, when we cut costs, the thing is, we are making sure that we are effectively using our resources. We're trying to maximize their use. Sometimes it's called technical efficiency as well. So you can see here, if we were producing less, the cost would be higher. But as we get to that 20 units of output, our costs are now lower. So we are productively efficient. You can identify it. It's not quite, I should have changed this, but it should be pointing right there. Right there is the productive efficiency. So please note that perfect competition is both productively and allocatively efficient. All right. Let's talk a little bit about the strengths and weaknesses of the perfectly competitive market structure. What's good about it? Well, as we just said, they're both allocatively and productively efficient in the long run. When you look at perfect competition, remember that a moment ago, or a while ago, we said that prices rise and fall. When that happens, we cease to be allocatively and productively efficient. There are times where costs will rise or fall in the short run. We lose that productive efficiency. And so note that those two concepts of allocative and productive efficiency, that does happen for perfect competition. And that's a good thing. It's a strength of this market structure. If being efficient is a desirable thing, we want to be efficient. Next, some consumer sovereignty. So the thing is, the other markets, the other market structures, often producers, and this is especially true with monopolies, they will have more sovereignty over what's produced and the price. Whereas consumers here have more sovereignty, or at least some level of sovereignty, where the market responds to consumer tastes and what consumers want. That's a desirable thing. So we want a market that functions where it allows both parties, consumers and producers, to play a role in the creation of those goods and services. Next, and this is also important, is that prices for most perfectly competitive market structures tend to be low. When you look at raw materials worldwide, generally a lot of them are pretty affordable. This is not always true, but in many cases it is. Also, with perfect competition, we have a lot of competition. There's a lot of producers. Generally, competition is something that economists will find desirable. They will argue that generally a lot of the competition improves efficiency. Only the strong survive. Also, innovation occurs due to competition. When firms are pushed by competition, they sometimes create new, better things. Now, that doesn't always maybe happen with this market structure, but in general, we want competition. As kind of previously mentioned, if a firm is not effective or efficient, if they're not creating products at an affordable price that the market is dictating, those firms won't make it, and that's okay. This is sort of like, Darwin's theory of survival of the fittest, but on a business context. Like, the firms that offer good products at good prices survive. The ones that do not fail. And I know that might hurt some people's feelings, but this is generally a good thing. We want this. Okay, finally, one of the last points is that there's perfect information. We generally say there's no asymmetrical information, that producers and consumers both know equally about these products. And so generally this is also a desirable thing. I mean, again, it is perfect competition, so perfect knowledge or no asymmetrical information. Let's talk about the weaknesses. I'm sorry I didn't have the animation feature, but we'll just go over each one real quick. One first problem is that normal profit makes R&D difficult. Firms that that are making abnormal profit have more of a budget to invest in research and development, and that's a good thing. Also, abnormal profit attracts investment. When really profitable industries or firms are making money, sometimes outside investors will want to invest in those firms, or those firms will seek the financial means to expand their business, and it attracts investment. So, generally, a lot of when we look at this market structure, there's not as much maybe research and development. Also, because we have a whole bunch of small firms, those firms aren't generally benefiting from economies of scale. If we have a whole bunch of little producers, they don't benefit from being a large firm and having this condition where they've got really low average costs because they make so much. Generally, we have a whole bunch of small producers that are making small or moderate amounts. Sometimes, and I know on the last slide we said that prices tend to be low, and that is true for some commodities. However, a lot of these commodities have really high PED and PES, so you've got these really steep demand and supply curves. So if there's ever a change in price and a change in quantity, you can almost always bet the change of the price will be larger because they're so inelastic. And that's not generally a good thing. Consumers and producers prefer stable prices. Again, volatile just means subject to big changes. Next, we've got maybe a poor use of resources if we're looking at the long run in terms of this perfectly competitive structure. We've got firms that are opening up, spending money on capital, whether that's buying a tractor or buying some excavation equipment. They're spending money. And then changes in the market, changes in prices, cause those firms to shut down. So when we've got all these businesses opening and closing all the time and buying capital and then not needing that capital, that might be a poor use of resources. We want capital to be used effectively and efficiently, and too many businesses opening up and then shutting down might not be a good use of our capital. Finally, it's difficult to meet the criteria of perfect competition. It's hard to find a good example. And we're going to talk about why this is in just a moment, but the criteria are so, they're so sort of lofty, so sort of ideal, like a bunch of firms, homogeneous goods, like, they're exactly the same, or sorry, homogeneous goods. They're all exactly identical. It's very hard to find something that really meets that criteria really effectively. So what I want to do is talk to you a little bit about the real world right now and why, what's happening with a lot of agricultural goods and metals, and why we think, oh, commodities are a great example, when in fact they're not. And I want to hit you with some real world stuff that if you throw this in your paper, looks really good. Let's take a look. One thing to note is truly the best example of perfect competition is foreign exchange. When we're looking at currencies. Currencies are identical. We have perfect information generally with currencies. There are tons of buyers and tons of sellers. So really, Forex is the best example. But all these other ones that we were talking about with agricultural goods, metals, raw materials, this is not really the best example. And let's talk about why. For one point, in many countries, a lot of agribusinesses are dominating the production of many goods previously identified as perfectly competitive. If you would have gone back 100 years ago in a lot of both developed and developing countries, you would find a whole bunch of different producers producing wheat or mining metal or mining oil or producing all these commodities. But now, we see a consolidation of these businesses. Meaning, when I say consolidation, we're seeing fewer and fewer businesses control more and more of the market. And these businesses are becoming as you have less competition, it's hard to meet the assumption of the model that we have a lot of firms. So it's difficult to find these examples. And again, this is true in both those MEDCs and LADCs. Earlier we said that, we don't see much in the way of research and development, but like with agricultural goods, that's also not true. Like think about all these different fruits and vegetables, and even like cotton. Monsanto is famous for, it's a chemical company that produces genetically modified seeds. One of the genetically modified seeds they've created that's really famous is their cotton. A lot of farmers use their GMO cotton because it's resistant to, once you spray it, it kills all the the weeds that would normally hurt the cotton. So it's yielding a lot of cotton per plant. So this genetically modified cotton is something that's happening everywhere. And so it's not necessarily that the individual farmer doesn't have the ability to invest, but there are other sort of firms along the supply chain that are investing in research and development and then selling it to the farmer. And so we do see some research and development in these industries. And so it's not necessarily, when we said earlier it's difficult to find it, it's not always the case. Monsanto would be a good example of how we see changes in agriculture and in other commodities like cotton. And these markets are becoming, their research is improving these markets. Finally, and this is really important, this is the big nugget, this is what I love to share with people about economics, is that commodity prices are not functioning due to financialization. What that means is that when I say financialization, commodities now more than ever are bundled and bought and sold in commodities markets. So you've got these commodities markets or commodities futures markets where people will go and buy commodities, and they'll buy a certain, like a certificate basically that is like almost like a security, like they're buying a commodity on a trading floor, and they're buying all these different amounts of commodities so they can make money. So you've got a lot of commodity traders manipulating prices, and a great example of that is Goldman Sachs and the aluminum market. Here's an article that you can read about this, but Goldman Sachs, which is this investment firm in the United States, was buying just tons and tons of commodity, aluminum on a commodity market where you could go and just buy commodities from producers. They were taking that aluminum and hoarding it, stockpiling it, kind of putting it where, trying to hide it and drive the price of aluminum up. And as the price of aluminum got higher, they were able to sell it for more than what they bought it for. So basically what we've got here is an example of one competitor, one investment bank manipulating prices and causing manipulating the market really, and causing aluminum to go up, and all the companies that needed aluminum, whether that was a car company or Coca-Cola, had to pay higher prices. And these perfectly competitive markets don't function the way they're supposed to when you've got these investment banks coming in, buying up all the commodities, storing them, driving up the price. This is not how perfect competition should, in theory, be working. Not with this type of manipulation. It's sort of an unnatural shift in demand and supply. It basically puts all this profit into the hands of Goldman Sachs, and it hurts consumers and it hurts producers. All right, thanks for listening. Have a great day, and I hope this helps. Bye.